Hi, welcome back to another edition of Flippers Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'm going to be presenting estimated net flows into the conventional fund business. We'll talk about ETFs later on as well. For the week ended Wednesday, June 24th, 2020. We had about $4.7 billion enter the conventional fund business, and unlike the prior weeks, most of this went into fixed income funds. We saw money market funds lose a little bit, and equity funds actually hand back a little bit of money as well. And this is because we've seen some big volatility. As we all know, that there was kind of a narrow lead in the markets. Basically it's been a tech rally. We've had some small caps and some other areas actually do better, but really the Apple hitting all-time high this week. A couple other big tech companies did well. I think investors were very hesitant on putting more money back to work just because of what they're hearing with the coronavirus increase, the capacity utilization for ICU beds in Texas nearing capacity, and then also we heard that there was some new threats of trade sanctions being put on our European cohorts by the President Trump administration. And I think that just put investors kind of back on their heels with what's going on. The Dow this week, along with the Russell 2000, actually saw pretty big declines, 2.58% decline for both of those. And this is really after the World Health Organization came out and said we have a new and dangerous phase of the coronavirus occurring. And again, I think it just put investors back on their heels as they're in kind of a wait-and-see mode to see really what happens. Well, let's see how that panned out, the bit of news panned out as far as flows for the fund business went. Let's go ahead and take a look at our macro groups and see how that particular group did. We see that at a macro group level, equity funds lost about $3 billion, as I was saying. We saw that the fixed income funds added about $7.3 billion. Municipal bond funds actually took in money as well, about $1.2 billion. And we see money market funds, again, hand back just a little bit of money in comparison to what they've been doing. About $726 million left their coffers. So, basically, again, it wasn't a big story for the week, but I think that's a story in itself. We didn't see big, rapid moves either in equities or in fixed income. It was a nice run for fixed income, actually. But money market funds. So maybe we're hitting back to where people are instead of just being mass sellers or mass buyers, they're actually selectively investing into certain asset classes. Let's go ahead and take a look at the equity fund group and see how that panned out. For equity funds, we saw they had about a 1.57% decline overall. It's the second consecutive week they've seen losses. And again, they handed back about $3 billion. The ninth consecutive week they suffered net outflows. And how it panned out, if we take a look at domestic equity funds, they actually lost about $305 million, so not a lot there. Second consecutive week, though, that they've seen outflows. And for the second consecutive week, also, they've had negative performance, this time to the tune of about 1.99%. However, if we take a look at non-domestic equity funds, they're the ones that actually took it on the chin. About $2.7 billion in outflows, 12th consecutive week that they've seen outflows, and they actually had a better time mitigating losses than their domestic equity counterparts, losing about 0.63%. Again, second consecutive week for them as far as outflows go. Now, how this kind of broke out, we'll get a little more detail. Mid-cap funds saw the biggest outflows, about $509 million, while small-cap funds saw about $413 million. But maybe in a change of event, and they told you kind of investors being selective, large cap funds actually took in about $637 million. And then if we take a look at the equity side of the arena, we see international equity funds lost about $1.8 billion, and global equity funds saw about $938 million leave their coffers. So that was a little bit of a story on that side. Investors have really been kind of shunning the international group, and this is why they're looking at the trade agreements, they're looking at the increase in demand or decrease in demand that's going on with oil and raw materials and energy and the like. And in fact, we saw emerging markets actually be kind of one of the big losers of that international group that we were talking about. Well, let's go ahead now and take a look at what happened to the equity fund side of the business and see of the ETF business and see what happened with that group. We see that for equity ETFs, second consecutive week they've lost money. It's $1.9 billion in outflows this week, and the big attractor of money was the Spider Gold GLD. ETF, basically taking in about $2.3 billion. And then we saw the Spider Dow Jones Industrial Average ETF taking about $805 million. But on the flip side, if we look at the very bottom, we see Invesco QQQ, the Trust 1, actually lose about $1.2 billion, and the Schwab Fundamental U.S. Large Cap Index, ETF, lose about $715 million. So really, we're kind of seeing the same kind of agreement in outflows, though, from both ETF investors and also conventional fund investors in this case, which we haven't been seeing. We've been seeing, ETF investors basically putting money on, taking money and putting it back to work. But again, I think the news and the increase in coronavirus cases has really kind of changed some of that attitude. And again, it's more of a wait and see approach. That brings us now to our fixed income group. And our fixed income group, again, saw some pretty good flows. For the 11th consecutive week, they've taken a net new money, $7.2 billion into the conventional fund business this week. Second consecutive week that they've also had negative returns. And if you look at this chart, a negative 0.40% decline. So again, it's kind of the safe haven, people looking for the yield, and where we saw money really get piled onto was corporate investment grade debt funds took in about $5.8 billion, corporate high yield funds took in about $722 million, but on the flip side, we saw some minor outflows. Flexible funds lost about $34 million, and high quality, kind of the AAA, A-rated funds, that type of thing, high quality funds, only lose about $26 million. So really not a lot to write about there as well. But if we take a look at the fixed income ETFs, we see the same story. We basically see that they're put money back to work, and we see that fixed income investors are kind of doing the exact same thing that the conventional fund investors are doing, and they put in $4.1 billion back to work into this group. 13 consecutive week they've taken net new money in, and at the top of the group we see the Schwab U.S. TIPS. That's Treasury Inflation Protected Securities ETF, taking about $1.2 billion, and the iShares 20-plus year Treasury bond taking about $554 million. Now at the bottom of the group, we saw the Spider Bloomberg Barclay High Yield Fund, this is a bond fund ETF, lose about $574, and we saw the Schwab Intermediate Term U.S. Treasury Fund lose about $478 million. So again, the story remains the same. People willing to put a little bit more risk on the fixed income side, but really are very reluctant to jump back in to the markets as far as equity funds go. Well, that brings us now to our Muni Funds group. And the Muni Fund group has actually done a pretty good job this week as well, taking about $1.2 billion, 7th consecutive week that it's taken in net new money, and it's the 8th consecutive week it's seen plus side performance, this time to the tune of 0.19%. Now remember, these are weekly returns. When you're seeing 0.19, 0.24, 0.67, those are pretty good returns if you start talking about adding them together or trying to annualize them. Pretty good numbers. The big attractor of money was short muni debt funds. They took on about $399 million. And then we had the general and insured municipal bond debt funds taking about $381 million. Now, if we take a look then at muni ETFs, they took in about $286 million this week, and I believe it was like the 8th consecutive week they've taken in net new money as well. So it's been a good run both on the ETF side and the mutual fund side. That last number I gave you is just out of recollection. It could be a shorter period of time, 6 weeks. Anyways, now that brings us to our money market funds group. In our money market funds group, as we take a look at this group, we see for the 6th consecutive week they have actually handed back money. But this time only the tune of $726 million. As before, we've been seeing 35 billion, 31 billion almost on June 10th, for the weekend of June 10th, hand back money. But this time, basically, it was a little bit more moderation. We see that taxable money market funds actually took in about $800 million this week. How that panned out is basically we saw institutional money market funds. Those are the ones that we actually probably use for our 401ks, and probably some corporate managers are out there as well, using park money as well until they have to make their payments on a quarterly basis or monthly basis. But we saw the retail investors actually added about $1.3 billion to the group. And when we break that out a little bit further, and I told you that we had good inflows into taxable money market funds, or tax exempt muni bond funds, we see that tax exempt money market funds actually handed back the lion's share of all outflows that we saw here this week, and that was only to the tune of about $1.5 billion in outflows. Well, that basically does it for me this week. Obviously, if I haven't done a deep enough dive, you can go to our website at www.lipperusfundflows.com, or you can take a look at our video next week. One of the things that came up today is, we had another 2% decline. This is Friday, and we had about another 2% decline in the market, or over 2% decline in the market. And certainly it is because of the increased COVID cases. But we did see May personal income drop by about 4.2%. During the week, we actually saw that the new weekly unemployment claims for the week prior actually increased as well. But one of the good news is that we did see this week, and we kind of expected that, was we saw an increase in durable good orders. It climbed about 15.8% in May. So there may be a little light at the end of the tunnel, but of course we are going to keep our eyes on the COVID case. I think that's really the bottom line for everybody. As the economy's reopened, are we going to stutter? Are we going to have reclosures? People are backing off, and if they had 75% reopenings, they're dropping back to 50 or 50 to 25, and that certainly will impact profitability of the companies that we're investing into. And I think that's going to be a major thing that people are keeping an eye on. Well, thanks for joining me today. My name's Tom Roseen, wishing you the best in your wealth planning and creation.